Hello, everyone. Um, Welcome back. Friday, this is one of the reasons Friday is one of my favorite days of the week. Um, Yesterday was fun with Derek and his group, and had a lot of good discussions there, and it's really nice to have back to back. So I encourage anybody who wants to do one on Wednesday. That'd be just fantastic for me. Get the morning going, talking to our friends about trends and anything else that pops up. Um, I've had a busy week, and I really enjoyed my time with the Everything Money guys. I just start smiling when I think about those guys, and I think that was PD's first appearance on visually on a podcast or anything. PD is often heard in the background, but and then they gave me a new kind of whatever you call it moniker, where PD is I have a big head, and PD is on my shoulder once again. Very fun. Um, and then right after this, I'm going to get right into in a couple of hours with Niels with our um, podcast. So this will get me going, all fired up. And with Niels, I usually start like at 7 a.m. Eastern now. So this time it'll be 10 a.m. and I'll be sort of awake. And so it'll be, you should expect more out of me, you know. And if anybody has anything you want, I know we're all waiting for the match between Rob and I. But if anybody, I can still get into it with Niels. Insult him in some way, and we can really get into it and have a really death match over trend, etc. Um, I was trying to go through my Twitter feed today and see was anything that really caught my eye this week. I really liked Richard's post in Twitter about volatility, schmolatility, apply a rules-based process that enforces asymmetry into the process. And then he had a screenshot of what the chart looks like if you look at the days, years, and decades, and all the volatility, of course, from the days chart it gets minimized by the years and kind of goes away totally by the decades. And I think that's a really good lesson I've learned over the years is being so concerned about today and this month and what's going on. And I remember Bill Eckhart has a quote about that, about how that's sort of natural for traders to obsess over recent performance. And then in a month or two, we won't even be able to describe it. I invited Moritz to join us today to talk about spreads because we talked about spreads a bit last week. So maybe I don't see him here yet, but maybe he'll show up and give us some. He was willing to discuss, I guess, somewhat the spreading idea. And then one of my favorite quotes this week that I found um, that I really identified with was from Jerry Seinfeld. So yeah, he must be a trader in some ways, but he said, "If you're efficient, you're doing it the wrong way. The right way is the hard way. The show was successful because I micromanaged it. Every word, every line, every take, every edit, every casting. That was my way of life." And I feel like that's sort of what I try to do as well, is just micromanage. Like we talk about our systems and a one entry, one exit, and a stop loss. It sounds so easy, but sort of behind the scenes, putting all of this together. And if you're kind of obsessed with perfection, it can be a detriment. But um, there is a lot to micromanage behind the scenes, the markets and the sizing, the systems, and not optimizing per se, but just, and then when you don't do that, you realize, I think I should be more interested in details. So that too I've gotten better at that. I had no idea going into the Turtle program that was something that could do and I wanted to do. But I changed quite dramatically in that regard of being creative. I never thought I was creative, nor did I think I had the stomach to be very detail oriented. But at least in this area of my life, that's my goal. So I'll start inviting our usual crew up here. Good morning, Oleg.
Good morning, Jerry. I'm very glad. I usually said very glad to be here, and it's totally truth. Yes, and I want to say that I like very much. I like very much the idea of doing the hard thing, as you all know here, because. But I think that it's hard when you are not prepared for this, and I think we must train ourselves, train emotionally to do the best thing and to do the hard thing, and it will not be hard anymore if we are trained like in sports. We must know what is the better things. For example, we must know that I know because of you, Jerry, and Niels, that long-term trading is the best approach. And these drawdowns, it's the price that we pay for our success. And with knowing this, with if you know this, if you believe in this, it's not hard anymore to go to this way. It's not so hard. It's not hard. I think so. It's uncomfortable maybe for most of the people, but if you train yourself emotionally and do a back test, it's not so hard. It's okay. It's happy.
Absolutely. Uh, I completely agree because I think one aspect of trading from a public view, let's say, is that you could just come in the market and pull the lever like it's a slot machine and you'll make money. But a lot of people underestimate the amount of training that it actually takes to condition yourself to an objective mindset, to where you're actually counting the numbers right, and you aren't saying, "Hey, here's what I want the numbers to be." Um, I think that that is something that is very overlooked, because when it comes to creating, let's say, a training program like that, you could say that there's the generalized industry standard. Of course, you want to know if you're going to be trading options. Of course, you want to know how do options work. These are the basics. But once you understand the mechanics of the instruments, then concepts like sizing up, uh, rebalancing your portfolio, risk management, all these are going to come down to the temperament of the individual. Do they have the patience to hold a position for a long amount of time? Do they have the speed to scalp? I know that's been a huge change for I would say myself over the past couple of years. I used to be a much faster scalper earlier on when I first started trading, because I actually had the processing speed for it. But I found myself slowing down in a sense that I couldn't execute those trades as proficiently. So I said to myself, well, is making the amount of money I'm making worth the amount of effort I'm putting in? Because I think that's one of the joys of trading. It's once you master it, if you can master it, right? That's there's something we could debate. Um, if you can master it within yourself, I'll say, then it really does become effortless, because there's no struggle anymore. Um, once you learn any skill, really, once you get to a level of proficiency within that skill, uh, and you eliminate, or I should say minimize, once you minimize the probability of you making an error when you go to execute a task within that skill set, then I think you get a lot happier about showing up to the markets and saying, hey, whether or not I make money or I lose money today, it really won't make a difference, because not only is there tomorrow, but there is another opportunity, and some would even say a winning opportunity, on the next side of the sample size of this one trade.
That's really good. One thing I would say is I think it can make a difference. I think this is the problem we have. If you blow a trade, you don't do it, you don't handle it the way your system calls you to do it. Uh, there will be, just because it could be an outlier, it will make a difference. But having done that many times, especially early on, you're right. You got to keep going. And so it's going to be one of many trades for the rest of your life, and put it behind you. I know many times I've just looked in the mirror and said, okay, in the 80s when I got started, like, put it behind you and let's move forward. There's nothing else you can do. So, and I wanted to comment on the training idea too. The training, I just remember, I've said this before, that giving people rules and knowledge and mentoring, it can help, but like there's just no way I could have achieved what I achieved with just the rules and the knowledge and the turtle notebook. Just having 4 years there was like a Marine boot camp. So here's the Marine manual. Now go out and be a Marine versus, you got to hang out with people and talk to people and receive their encouragement and criticism, and then mold you into something that's far beyond just knowing rules and doing a back test. Um, so that had a profound impact on me. And, like I said last week, when you lose money, and most clients, that's just the bottom line. But with those guys losing money, well, that's okay as long as you're following the rules and the process and doing the right thing, doing the hard thing. Um, so I think that's just invaluable. I'm not saying that you have to be in the Turtle program or work for a trader to make to achieve a lot, but it certainly is a big, huge edge.
And I want to say that I said before that being in a short-term space, it's very good for training. It's very good training because you understand that you must execute a lot of trades. And as for me, I'm talking about my own experience. I was a short-term trader, and like Dick once said, that I also can't execute all trades in a proper way. And also, I thought that it's a lot of noise in the market, and if you're doing, you must be very focused on the markets. You must, and you see a lot of sample size, a lot of trades, a lot of exposures for all these markets. And if you diversificate it, more complex, it's going to be more complex, and it's good as a training. And after that, when I understood that long-term space is more perfect, I began to be a real lover of long term, and from premium to long term trader. I understood that I love it because I know the short term space. And maybe I don't know the short-term space in all these aspects. I had a lot of different research in it, but in last episode of Neil's episode of Top Traders Unplugged, he said that maybe in short term we must do something different. And I even had such ideas, but I decided to be a classical trend follower because it's really the best what I have seen. It's really the best.
G'day everyone. Look, when we're talking about short term, medium term, long term, I have a slight issue with it because the way I tend to think of the systems that I deploy, if, for instance, we're regarding short term as any trading system that operates over a look back of, say, maybe 20 days, 30 days or something, and a medium term system is something that operates off a look back of, say, 50 to 100 days, and a long term, maybe 150 to 200 days plus. I tend to find that a bit deceptive because the way I view the market distribution of returns is that there is a region in that distribution of returns that I don't want to get involved in, no matter what holding period my models are. So, when I look at all market conditions, I say, right, let's isolate out those conditions where I want my models to be active. And those models might hold for short periods of time, medium periods of time, long periods of time. But what they're doing is they're saying that there's this filter being applied to say, let's exclude this particular regime or this area of the distribution of market returns. Let's exclude it in its entirety so that my models are turned off. They don't get involved. They don't participate in any trade event until I get to these more exotic conditions where price stretches away from the mean of that distribution. So we might be 3 sigma events away or 4 sigma events away from the mean, where suddenly then all of my systems get turned on. But then when all my systems get turned on, yes, I do deploy what I regard as short-term, medium-term, long-term systems to capture different facets of that outlier. And so the short-term models might be holding for short periods of time. The medium-term models might, medium-term lengths of holding period, and the long-term holding periods we might be holding for 2 to 3 years. So that's the way I tend to think of short-term, medium-term, long-term, as opposed to treating it as all one bucket, trading one complete market distribution of returns and defining my short-term, medium-term, long-term models within that context. Does that make sense?
Well, I mean, I think it's up to us to figure out a way to get you to divulge more of this of these gems. I'm trying to sit here and think this perfect question I can ask. But it sounds like that maybe what you're saying is that, okay, so I may have like a 100-day high to get in and a 75-day low to get out, my shortest term system. It sounded like what you were kind of saying is I have a 200-day entry for everything. I'm just going to wait for this incredible breakout of 200 days higher. And then with that, I will, for all my systems. And so then with that, I will pair, the 50-day low, the 75-day low, the 100-day low, the 150-day low as my exits. So I got this
That's
impression.
exactly right, Jerry. That's exactly right. That's what I'm saying.
How good am I? Yeah. Okay. That's interesting. Yeah, I like that.
I have a question, gentlemen. How is that not de facto vol targeting? And I'm not advocating one way or the other. I'm just simply asking.
Look, vol targeting to me is dealing with the profit side of the equation. So what we're doing is we're saying we are waiting for these conditions of the market to get extreme before we enter a market. And then when we enter a market with our models, all of our models, none of our models have profit targets in them. All of our models just have an entry, an initial stop, and a trailing stop. That's it. So the trailing stop is a mechanism by which we get out. If we had a profit target in our models, that's when we're volatility targeting, because what that's doing is it's saying, I am going to sacrifice some of that possible infinite profit for a smoother cash flow by taking a more reliable sequence of profits by putting a target in there than holding back and waiting for the market to dictate how much profit you get. So the market, the volatility targeting to me is all about not letting those profits run. It's not about any other part of that mantra. It's just about the letting profits run. And I don't do that with any of my models. But what I certainly do is with my models, when I decide to make them active, it's only when we're getting price extensions or we're getting price movements that are getting more extreme, more non-normal in nature. We're starting to get this volatility expansion. That's the only time that my models actually start becoming active.
By the way, I had my own research on this topic, and I made a system that I traded. It's vol targeting. I was trading when I had -10. I began to trade my trading session, and when I had plus 10 or plus 15, I don't remember, I stopped this. And in 2015, 2016, it worked well. until it was some situations after Brexit. And so the point is here, I came to conclusion that it's a very complex way maybe of doing the things, and a problematic way, and I decided not to do so, but I had big research on this topic, and I even traded in this manner. I traded a few different strategies, so minus 10 plus 10, minus 10 plus 15, and so on and so forth. So here is my point.
Richard,
Yeah,
can
the
I ask you a
process that
question? Sorry,
go
Bruno.
on,
Go
Andres.
ahead.
Go on.
Thank you. Is the what you are saying is something like, if I understand well, that you have a single entry parameter, a single entry parameter, and a diversify multiple exit parameters on your system?
No,
Very,
no, 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 no. It wasn't so. I'm sorry. It wasn't so. I had multiple. So one single parameter minus 10, two plus 10. The second strategy minus 5 plus. 5 plus 5 maybe, or minus 10 plus 5, different types of parameters, not single, but anyway, any way, I decided that it's not the best approach, and I stopped doing this. Uh, I stopped doing this, and in fact, when I get known, when I had this knowledge from Jerry and Niels and Maritz about true classical trend following, I stopped doing anything. So I decided to trade only in a classical trend following way and nothing else, trend following plus nothing, because I really see that it's the best way. So here is my.
Thanks. And you, Richard, in your system, do you think it's something like that?
Look, what I do is I say there is a point where all of my systems are turned off. Then there is a point when price starts getting more extreme in its movement. So we're using, for instance, a Donchian breakout or a breakout method to define what do we mean when price gets extreme. So when, for instance, I get to levels of, say, 100 period breakout, look back, that means that over the last 100 days, long or short, price has had to do something a bit sort of, different to get to those levels. It's had to sort of, there's a bit of effort for price to actually reach the 100-day breakout or long or short. I might put a little volatility filter in there as well to ensure that not only am I waiting for that price to get more extreme, I'm also waiting for signs that volatility is expanding. So I'm looking for momentum to generally be on the increase. So that's sort of my entry condition. However, not all my models activate off that same point. It's really, that's where they all get turned on. And then I've got a schedule of different lookbacks, maybe 150, 200, 300, 400. That schedule of lookbacks is to create entry diversification into that outlier. But every single one of the systems that are deployed when the systems get turned on are configured separately in their exit condition. So that's where I would say I am different to pyramiding, because the different trend trajectories that each of those systems is targeting is specific in nature, and it's capturing different aspects or different trajectories of that outlier. We've got some quick models that take quick profits. We've got medium-term models that hold on for long periods of time with tighter, fairly not as tight as the short models, but tighter trailing stops. And then the long-term models have the looser trailing stops that allow me to ride for a long period of time, if that makes sense.
Hey guys, hi everyone. Richard, by the way, I'm trying a new set of headphones. If my audio is bad, please let me know. Richard, take care of your words. You're saying quick profits. People are going to get triggered here. We don't talk sins in this clubhouse.
Good point, Bruno.
I would say that from your description of system, it's not that it's I wouldn't say it's quick. It's just less less tolerant of a give back.
Yes, I'm
And
giving
I
less
see,
room to breathe. Yes.
yeah, I see the value here. I understand what you're doing. Um, I wouldn't say this is volatility target as Brian was asking, because just by this description, of course, because suppose you have a set of systems that they all get in the trade in the 200-day breakout, but some will exit at the 50-day low. The other one will exit at the 100-day low, and the other one at 150, and so on. And this way, you're some the intention is I believe is to attenuate the give back, but it's not volatility targeting, because as the trend goes on, the volatility goes up, and so will your open profit. If it was volatility target, you would decrease or the size of your position in order to not be exposed to this increasing volatility as the trend is going in your favor. I would put
Exactly,
this,
Bruno. Exactly. And you know,
yeah,
you might be in an instance where you get this lovely exponential market move at that point that your systems start triggering. Then you find in that condition that your short-term models, your medium-term models, your long-term models all catch that exponential move, because there is no profit target in these models. That the trail is just the trailing stop is just not being activated. So it's capturing all of the possible non-linearity in that outlier as much as we can through a more diversified suite of classic trend following models that are just configured separately. So it's investing efforts in system diversification as opposed to allocating all of your effort into one system on one market. This is saying invest your efforts in 10 systems on one market to get some benefits also of diversification of systems within your portfolio result.
That Richard, that sounds very similar to my short-term method, which is based on point and figures, and then my medium and long-term are based on the traditional, Donchian breakout method, and so that's why I asked that question. Was if you're entering on the Donchian and exiting on entering on the 200, exiting on the 50, if through your back test that showed that you were in the long term reducing your profit potential, but by the same token, those of us that trade our own money or family money know that returns are important to the client, so to speak, or having to cash flow life. So that was the basis of my question. Is it sounded very similar to what I do, and I've often wrestled with the trigger point versus the exit point, and if in fact that's something that I know is a long-term setback, but a short-term gain, so to speak. In other words, it's a beautiful tree, but I'm missing the forest.
I get you, Brian. And look, yeah, it is similar. It's using a variety of different trend following systems. You're using your point and figure, etc. The only nuance I'd say here is that if we could imagine how a histogram plots, so the market distribution of returns, and recognizing that we only want to get involved in these trade events, when we get to these, what we call these tail events, which is where um, we go beyond the extent of the normal distribution tails, and we have these fat-tailed areas. Now, they occur multiple sigmas away from the mean. So I'm saying, don't trade. What this means is that our models only trade incredibly infrequently. Each of our systems only trade very infrequently. But we've got so many of these models, we've got so small bet sizes applied, we've got such wide diversification. We're really focusing on the tail region of the distribution of returns before we actually activate our models. And, like if for instance, I had a back test and I looked at that back test and say, what do I really want in this back test? Well, in this back test, I want all outliers. Every single one of my trades, I want to be outliers. Now, that's theoretical. The reality is it doesn't happen that way. But ideally, we only want to focus our efforts on outliers. So it's saying, what are these outliers and how do we capture them? And it's saying, well, there are particular regions of that distribution of returns which are more probable to participate in outlier events than other regions. And it's saying, therefore, restrict your models to not trade during those other areas, because otherwise you're going to be caught with a lot of noise, a lot of mean reversion, a lot of whipsaws. Your breakouts are going to get many, many whipsaws if you're trading short-term models from the get-go, 25-day look back. So I do catch outliers here, but all of the profit of those outliers is whittled away by these many, many whipsaws. So it's saying that's a regime of the environment you don't want to be involved in.
I wanted to pick up on Brian and the vol targeting idea. And I think it's kind of funny, if I may have missed this, attributing this idea to Richard, that he didn't mean to, but I think at some point Richard was using interchangeably vol target and taking profit. And I think that's kind of funny, because that's kind of what I accuse vol targeting is. Just it pretends to be um, put into the portfolio because, oh, we're so concerned with risk, and we have to keep this risk at a certain level. And then it's just, hey, look, if it just so happens to get me out of a big profit prematurely, and I can scratch that itch of taking profits and not waiting for my breakout exit or my moving average crossover exit, oh, well, I guess I'll just take it. But trust me, it's only in there because I'm such a dedicated risk manager. And of course, for me, taking small profits is managing my risk and the diversification, and letting profits run and letting that be volatile, I don't consider as a necessary part of my risk. But I thought that's kind of funny. But I think it's interesting. What Richard is saying basically is that regardless of your entry and exit and how you do it, um, if the ATR has doubled or tripled since you put the trade on, then this would be a signal for people who use vol targeting to trim back that trade. I put the trade on, it was a half a unit, the ATR was 100, now the ATR is 200 or 300, and obviously I have to violate the idea of letting profits run, because it's now too much of my portfolio, and what I intended that trade to be originally is one small trade out of lots of small trades is now becoming a relatively large trade. And so it made me think of, what is the purpose of this stop and risking a multiple of ATRs and keeping our losses small. And I was taught that the purpose of the stop has nothing to do with, oh yeah, we do want these positions to be kind of traded with the same juice and have at least initially, and that's all we can really control, is initially all of my trades are sort of have the same expectation. They're sized in the same way. They're going to risk, I'm going to risk multiple ATRs. I'm going to risk 25 basis points of my AUM, and then off it goes. And from that day forward, it's going to change. And I'm not going to do anything about it, because the only goal I had when I used the ATR and placed that stop was to normalize the size of all my losses. And it had nothing else to do with anything after day one. It's obviously going to go up in vol or down in vol. The losses have a tendency not to change very much in volatility. The ATR tends to be similar. But boy, you get a hold of some of these profits, and this asymmetry that goes crazy is can kind of produce these positions that are, the ATR could be as much as 10 times as what it was when you put the trade on.
I just refuse to look at my trades once they've entered. Once they've entered, that's it. It's game over, and I force them out of my head, because, and I don't look at my charts either. I rarely look at my charts. The only time I pop in And that's because I'm scared of seeing how much profit I'm exposing myself to before it goes back to the trailing stop. So, but the only way I can deal with this is just let the rules do what they do, and just don't touch those unrealized profits.
And I think that's really the totally logical conclusion that everyone should come to is before you even talk about the struggle of being consistent and disciplined and doing the trades that you executing the systems that you've determined that are the ones you should do based upon the back test. Why are you looking at these markets? And what do you mean it's hard? You shouldn't be looking at these markets. Give your trades to someone else. Email them to the broker in the morning. Put together some sort of internal controls, division of duties, and mentally at least, uh, you know, don't don't look at charts and don't look at, a while back, I think Derek a long time ago asked for on Twitter, what do people look at like on a daily dashboard? And I misinterpreted the question, but what I look at daily, or what I can look at daily, I have these reports that I get, and I'm like afraid of these reports because what I look at is maximum P&L, current drawdown, maximum possible drawdown, and then it's color coded. So like if it's red, oh my gosh, it's a big trade, or it's a big drawdown. And so I have these things in my reports, and probably the person who does my reports is listening. So, but I have a tendency, like, I don't want to dwell on this. I have it on my dashboard, but what am I going to do? And it's good information, but wow, you're kind of, if you're trading systematically based on rules, you should be in a clubhouse or paying attention to your fantasy football versus scrolling through charts.
Exactly.
Is there such a thing as fantasy soccer and fantasy cricket and rugby, or are these just American things?
We should have a trend following fantasy league or something. That'd be fun.
That would be brutal, Brian. Come on, we're all competitive enough.
No, I like that idea, and I may have mentioned before that I've watched football my entire life, and so and I've only watched hockey recently, NHL ice hockey. So I did so much better in the hockey because I just paid attention to my spreadsheet and I had no bias towards for or against any of the players, unlike football. So the more systematic I became, having known nothing, in, at least a few years ago, about hockey, like in trading, it worked out so much better.
Has anyone, particularly our overseas club members, have they seen the movie Moneyball and sabermetrics and how that really came to light for baseball?
Yeah, that's an excellent one. If you guys want to put up a fantasy, something hockey, football, I don't know, I'm game. In spite of not understanding nothing about hockey, football something.
Yeah, so back in the '90s, John Henry was one of the most famous and best CTAs, and maybe like what I would consider to be the original managed futures CTA. And what I mean by that is that managed futures kind of was a term that got coined by I think someone at Merrill Lynch, and they they were famous for coming out with these public funds that had very high expense ratios, ridiculously high, and they could raise hundreds of millions of dollars. And John Henry was their go-to for these funds, but it wasn't just Merrill; it was all the big wirehouses. And um, I remember being in these funds, and the annual hurdle maybe exceeded annually like 10%. And I tried to finesse this, like how are we going to trade this money and not, get crushed by this fees. And then all of a sudden you look up and it's February and John Henry's already down 20 or 30%. And then I figured out, well, they're fine with that because in order for them to overcome their own fees, this 10% hurdle didn't even include Henry, which was I think 4 and 15. So John Henry knew right off the bat, I have to trade like huge. Of course, I'll be down 30 or 40 regularly in order to make any money for the client and overcome all of these high fees. And he was very good at it for a very long time. He was a great speaker. He gave some incredibly great speeches, encouragement speeches in the midst of, certain years, drawdowns that the whole industry was experiencing. And then he decided to go and retire from being a CTA and became owner of sports teams and introduced analytics in a big way to baseball, especially. And he sort of hired, when I went to the Turtle program, I was introduced to trend following trading and rules and Richard Dennis and Bill Eckhart, plus computer baseball, and plus analytics. And this one guy was writing books about uh, baseball and analytics back in the 80s. And I was fascinated by this. And John Henry hired that guy at the Red Sox. And so then John Henry used his skills in analytics and hired a great staff and really a famous general manager. And they won the World Series a few times, having not won it, I think, in 100 years. And so then he went to, I think, Liverpool soccer, and now he's threatening to buy one of the NHL teams, which I think it's Pittsburgh. And so then my team, the Tampa Bay Lightning, would have to deal with John Henry and his analytics once again. So I'm not looking forward to that. And so this sort of mindset of what did someone call it a few minutes ago? An objective mindset. I love that. This was introduced to me too when I went to work in the Turtle program, and this can carry over to all aspects of life: rules-based, backtest, analytics, and we see this with John Henry's life.
Yeah, I agree with you, Jerry. I think this is really important, a really important mindset to have. And by the way, Derek is among us here. Your blog post, last blog post, I think, where you were investigating how exits behave, that was a prime example of scientific mindset, of objective mindset. Thanks for that, Derek.
Sure. No problem. I just need better ideas or more time. One of the two. I hope to keep putting out more content.
Actually, Derek, I need to ask you a question. Jerry posted a very good post on the Twitter today about Katie Kaminsky's Alpha Simplex, and in that that article from the Hedge Fund Journal, this is what Alpha Simplex says. They said the philosophical focus is on more robust and simple measures that minimize over-parameterization. The different groups of models are different ways to measure trends. Shorter-term models are more about overcoming noise in shorter-term signals. So I get all of that. But then she says, machine learning and nonlinear techniques in Alpha Simplex have expanded to a 40% allocation, embracing broader, more complex approaches and techniques. It says the nonlinear techniques include kernel regressions, scenario-based analysis, and random forests. So over to you, Derek. What the hell does she mean by that?
Okay, I read part of that. Hang on. Um,
Spoon feed us, Derek. Spoon feed us.
yeah, I'm collecting myself. Give me a second. Okay. I can't back out what she's doing. But another thing that they mentioned in that article was that they have adaptive time. She says that her strategies will adjust their time frames based on the situation. They get faster or slower. That was my kind of read of it. I didn't read the end of it, unfortunately. I always read it on the bus to and from work, and then I get stopped out. Okay, so we can talk about just let's in general nonlinear, and we can talk about machine learning. And this has kind of come up in our previous discussions about correlation and the issues with correlation. And I'll use that as an example just because everyone here has heard that argument before. So the issue with correlation is that it's a linear measure of dependence. What does that mean? It means that if this asset X moves, then asset Y should move in a linearly proportional way, and then that is your correlation. So if it's 1 to 1, then it's 1 in correlation speak, or if it's 1 and then 0.5, you get something around 0.5. Everyone, I think, is clear on that. But we know markets are nonlinear, and the issue with the stats that we see taught in schools mostly, or even in the kind of classic modeling that you have for your standard deviation, all that live in this linear world just because of the elegance of the formulas. But with modern computing power, we are able to um, numerically solve these non-linear, non-closed form solutions. Okay, what does that mean? A closed form solution is like if I put these variables into a formula, I will output something. And that's why Black-Scholes is so important, because it is a closed form solution to options pricing. Otherwise, you would have had to simulate all of these types of paths to find the pricing model. And so when they teach you in finance, I think they teach you the Monte Carlo method, or and then you just simulate 10,000 of these paths, and you're able to get the same price that you would have gotten for the Black-Scholes. Okay, so now that's done. Okay, going to the random forest and the simulation part. Random forest to me is solving the correlation issue. Why? Because you can sectorize these assets in a dynamic way, in a nonlinear way. Okay, so imagine you have a basket of things, and you guess your prior as that these are in different sectors. We'll use equities, or commodities. It doesn't matter. You can have your ags, you can have your metals, you can have your precious, you can have your energies. And we know that these baskets, these little things, should have higher relationships with each other than the other things in your total portfolio. But what a random forest can do is it can tell you what are these dependents and how strong is the relationship, and then you can run it, say, like in a rolling period, and you would see how those relationships change. And because it's not subject to this linear assumption, it allows you to get rid of one of the biggest issues of correlation. I do something similar, but it's a clustering technique that does use trees. Marcus Lopez de Prado also talks about something there in his hierarchical risk parity, because you turn things vertical instead of horizontal, and you remove the error of inverting the covariance matrix. What does that mean? Okay, so there's we estimate covariance first, which is the explanatory variance of one thing to another thing. Variance is related to volatility. And when you invert it, you take it to the -1 exponent, the errors become exponential. And that is actually the biggest noise component of your correlation. It's just built in the formula that there is this one thing that if you mismeasure something by 0.1, it explodes. That becomes removed when you use these machine learning techniques for that. Okay, simulation. This is just me guessing. I'm speculating, guys. I'm not able to read Katie Kaminsky's mind. I'm a big fan of hers, and there's no way I have her acumen. the simulated paths and things I think would be related to what I consider like my laboratory environment. Being able to know like how to switch between regimes or how to switch between a fast and slow method. The thing is, it's like what this group considers simple and what she considers simple are probably two different things. But she will be able to do these types of scenario analysis and simulations to determine if she's capturing the optimal time frame. So going back to what she said earlier in the paper, I mean, this is just from my memory on the bus. Um, Imagine you have a trend following system that goes between fast and slow. It changes gears. So it goes from slow gear to fast gear. She needs to know that when it's in slow gear, she's capturing the maximum amount of slow, and then when it's in fast gear, it's capturing the maximum amount of fast. So there's a couple of things that need to be simulated there. One is this the best parameter set or set of strategies to get each or the fast or the slow? And then what about that dynamical change? When those regimes change, she's going to need to simulate lots of different environments because the sample size is effectively small. So by creating these scenarios, she will be able to boost the amount of sample size she has and create new situations which don't exist in the market to make sure her strategies are switching gears. That is my best guess. I hope the explanation made sense.
No, that helps a lot, Derek. Look, I know that she works under Andrew Lowe, and I did read his book on the adaptive markets hypothesis. It's a very good book. I think it really comes down to what we've been discussing over the last few clubhouses in relation to, we know as trend followers that our weakness is in the short-term space. As soon as those markets start sort of with their volatility expansion and start heading south or whatever, we tend to take a long time to be able to catch on to the move with our medium and long-term models. So, we've talked a lot about, and we've heard Harry and Top Traders and yourself talking about the use of options as a basis to get a bit of a more powerful punch in the short-term area with greater convexity. But I'm thinking that Alpha Simplex is certainly on that path, but they are 100% trend following, and I think this is more to Niels's case where he said these models need to be more momentum type models. But I have a feeling with the techniques they're using, such as machine learning, they're doing what the options are doing, but with these more sort of trend following models. And obviously adaptation is required, being able to quickly jump onto something, recognize when that adaptation is occurring, use these machine-based learning methods or whatever to identify quantitatively when these conditions might arise. So I'm just very interested in that because I know my weakness is in the short-term space and I'd like to know more, but obviously it's going to be a huge learning exercise.
I want to say that I'm not an expert in these machine learning techniques. I don't know, but I have such an opinion that I can't trust very much for this field because there's not much evidence of this being effective, and maybe this research may be effective. I don't know really, because there are a lot of things, and we all know this. We sooner or later we will see things that we have never seen before. And as Niels said, I like this very much, that if environment will change, a lot of artificial intelligence funds will blow up. And so when we are talking about machine learning, I liked very much a phrase of Jerry when he said that. He said that machine learning is very good, artificial intelligence is very good for sites where instructors teach how to brush their teeth, or the sites where you can choose a movie, something like that. I don't remember this phrase in Twitter exactly, but here is the point, that it's the market, Jerry said in this tweet, the market environment is a dynamic environment. So, and it's change. And I think that some things in the market, the structure of the market, in my opinion, the structure of the market. So we have trends, we have flat periods, and it will be always, I think so, until the market exists. Because I think that the market cannot exist without trends and without trends. So I don't trust artificial intelligence much here, but of course it's very interesting. It may be very interesting, such researches and something like that. But I have such opinion here.
It's not much about trust one process or the other. It's about, well, we have this new thing called machine learning applied to finance. Of course, we don't have evidence enough of how this performs. The guys using these techniques are pretty few, and this is pretty recent. I would just keep an open mind. Perhaps this has something to help us. And what's the way I approach this, I myself am not an expert too. I've studied by curiosity one of two topics. And what the way I approach this is, well, perhaps this helps us find a better filter to get in the trades. Perhaps this helps us find a better filter to attenuate our give backs. I just wouldn't say that, oh, this is the way to ruin, because the way we are applying, at least I can speak for myself, the way I wish to apply machine learning techniques to my models would be keeping in mind the golden rules of trend following. I'm not now to use some options jargon, as we talked about jargon. I'm not trying to short vol anytime. I'm all in the long vol side, the long vol, the trend following side. And I believe machine learning applied to short volatility strategies, that would be a faster way to ruin. But on our side, as an adjacent technique, just on a new layer of techniques and way to view the markets and evaluate the markets, I don't think that's that bad. Just would keep an open mind.
As for me, I don't trust much filters at all because, like Jerry said, you can filter you out from a big trend. And if I don't know how this filter works, on which it is based, because I don't understand machine learning techniques, I think it's a double problem. So here is my point.
I see.
Yes, it might be interesting, of course. And for me as a researcher, a lot of things in trading are interesting, but I'm afraid of doing some things in my trading.
I didn't get a lot out of that article that I enjoyed so much, and that I posted another podcast with EMC, and I just think both of those, the podcast from EMC and this Alpha Simplex article, are just a good examples of the exact opposite of the way I approach the markets and trading in general. But I was a little surprised that I thought they threw in simple and classic
And 0.5 sharp.
0.5 sharp. So that's what I'm getting for 0.5 sharp. Well, I read it closer, and it said they target it. So maybe, they're like, we have all these different ideas going on that we'll just target, quote unquote, a sharp that we know we can beat. But it did make me think that, it's in their, for organizations like that with so many smart people and who can even come up with ideas that most people can't understand in terms, they have a lot of money under management, and that's one of the keys for a lot of these firms is that it's really helpful to speak this language and to have enough trend and say some of these trend buzzwords along with the other buzzwords that very few people can even understand, because I think it does have a very positive impact on your AUM. But it did remind me a bit of this article I tweeted a few weeks ago about Lynx, and they were shutting down one of their AI um, funds. They had gone and did a special project to incorporate AI into one of their funds, create a fund, I think, and they ended up sort of closing it down. And one of the characteristics, I couldn't find my tweet, so I'm just going on memory. It was something like they said in the article that um, we need to penalize this AI system if it becomes too much like the trend following that we do. And so they said, yeah, that was kind of a mistake. so, if it's going to look too much like plain old trend, then we need to, we don't want that because we already have that. But taking that away really harmed the performance of the AI model. And so I think to some degree, I can just imagine that you're sitting there at these big firms, Alpha Simplex, and you're saying, no, wait a second, we need another algo. We've got these fancy algos, but we need another algo that doesn't get our performance too far away from trend, because sometimes that's going to work. It's the only thing that's going to work. It's going to work the best. And so the things they have to go through, possibly, I can only imagine to add value and be honest. And, when you talk about some of these ideas, that you have to actually do them, but you can't let it overwhelm, the trend to the degree that, and that's, I think, what happened to a lot of people in February of last year, that, short-term trend, the shorter term, the better, historically worst performing part of trend uh, was pretty much the only thing that worked really well. And the further you got away from that, the more dispersion of the returns were. But I think when I hear adaption, I really don't like this word adaptive. And all I can think of is that if you run the back test, which I've done, and you say to the exit, the 150-day exit or the 200-day exit, hey, the more profit I make on this particular trade, adapt yourself to then become a shorter term exit, so we don't give back so much profit, which once again destroys your sample size. And yet it definitely looks good in the back test.
I want to say that artificial intelligence, and as I remember, Niels said this, that artificial intelligence machine learning techniques, they deal only with the past. So the future is uncertain. And as I said today, before, that we will face sooner or later the situation that we have never seen before. And it's a very, as I remember, Jerry said this, that it's a benefit for I don't remember exactly, but as I remember, Jerry said that it's a benefit for to follow such environment, uncertain environment when we can see massive trends and so on. And artificial intelligence phones, they have they collect data sample sizes, but there will be unknown future, and this approach will not deal with this, I think so. And I agree with Niels here that environment will change sooner or later. It's my point on this subject.
Yeah, I think one thing that I've observed is, I guess, with the influx of mathematicians and statisticians in the markets, which is, welcomed for sure. I think there's a great amount of merit in there. But it's this need to try to think of the market as an equation, as a math problem. And I don't really think the market is a math problem. So I'm not even going to go into the, machine learning and all of that. I mean, I don't understand it to any degree that I can speak on it with certainty. But what I definitely take away from a lot of these papers, and you're absolutely right, Jerry, there is this new language. There's a language that you have to communicate in finance. And, I get that. I understand that on the institutional side. It makes sense because I guess it gives people the comfort of removing elements of certainty if you're putting all these numbers and things. But it's this constant trap to try to think that the market is a math problem that needs to be solved. And I think it's more than that. I think it's also a behavioral problem. I think you have to synthesize all these aspects of information and not just look at the numbers in many ways. So those are just kind of some of the comments that I had and thoughts based on this discussion.
Well, and I think to dovetail on Boris's, it's a people problem, not a math problem. I think it was Einstein that said things should be as complex as they need to be and as simple as they need to be, but no simpler. And I think that that's true with respect to the markets. I mean, it's ultimately a very simple. It's a simple solution. It's not easy to implement for the reasons that we talk and are here for each other for, but it is simple.
Yeah, absolutely, Brian. That's a good point. And just to clarify, I'm in no way, shape, or form saying that applying stats and math and that is useless. Absolutely not. I think it gives you a good benchmark. I'm just kind of hesitant to entirely rely on that approach because I think it goes without saying that a lot of the attempts is to remove uncertainty, to basically say that this is what's going to happen. And we have these numbers, we have this framework, this mathematical framework, which sounds very complicated. In many ways it is. And we have this language to describe that process. And it should give you some sort of comfort. I don't really buy into that. I think it's more than that. But it is a valid approach. It'll definitely get you places. It'll get you the right model. It'll probably help you raise some money and get you into the right rooms and might even have some success. But I think just relying on that and relying on the numbers and thinking that it's an equation that must be solved, and if you just apply the latest and greatest of technology and crunch the right numbers, you'll get to that solution. I think that's problematic.
Yeah, look,
But
I
honestly, guys,
personally think that when we say that the future is not going to be like the past, we're inherently therefore saying that the market is adaptive. Um, so I tend to think the market always changes, and we can't rely on a history as a guide for the future. But I certainly think that our models do need an adaptive ability in them to recognize that change is ubiquitous over the course of time. And what we see in the future will not be like the past. Therefore, to have a model that is a static model, and all our models are static models unless they're using some Bayesian process to adjust over the course of time. I think we do need to reflect this level of change in our models. Otherwise, we're going to find that the nature of the participant mix changes to a point where what were the parameters, what were the variables we used in our models no longer apply, which is exactly why we stepped out to longer term timeframes with our models from the 80s. So I do think there does need to be some adaptation in our models to recognize, but it's not necessarily a fast thing.
Yeah, we were just talking about objectivity and scientific thinking. I like this machine learning literature and methods because that's the it's a new area we are exploring in the finance world. It's pretty developed in the statistics world, and people are bringing it to the finance. And there are a lot of buzzwords, just like Jerry said. And honestly, from what I see of managers that call themselves quantitative, and they say that they apply machine learning methods and artificial intelligence, a lot of that is just simple statistics. A lot of that is just linear regressions, and that's a technique developed in the 19th century. It's far from cutting edge. But the buzzword now is machine learning and artificial intelligence, and then these guys can label themselves that's in this way. Um, that doesn't mean we shouldn't, from my perspective, that we shouldn't study and try to find if there is anything that can add to our models that we know that work. But I just like I said, I wouldn't be that skeptical of this usefulness, because just like the I forgot his name, but the guy from the Moneyball movie, just like he brought statistics to the baseball world, I think perhaps there is a way to bring machine learning to the finance world in a profitable way. We just don't know that yet.
I want to say that I maybe would believe a little, we will believe a little in machine learning level of adaptiveness if will they, some machine learning expert will tell me how they can do the adaptiveness. In other words, the adaptiveness must be everyday adaptiveness or maybe 1 week adaptiveness. Maybe so. And if they have every day they have new algorithm, or every week new algorithm, or something changes to the day before, maybe it would look better than what I see in this space, machine learning space now.
So Neil,
Right.
I'm sorry. So Moritz has joined us, and we talked last week about spread trading, and people brought up the idea that Moritz has talked about doing spread trading. So welcome, Moritz. I don't know if you want to get into it or I'll have someone ask you a question, but thanks for
I'll hit
joining us.
Moritz up with a question. Moritz, what we were talking about last week was that we were just talking about how when we're trading a commodity such as corn or soybean or whatever, um, we are actually really trading a relative relationship between corn and the US dollar, or soybean and the US dollar. And when we look at it that way in our portfolios, we might seem to think that we've got diversified portfolios across different asset classes. But when we get into the details, we find that a lot of that portfolio is denominated in US dollars. So all I'm saying is that we need a way to mix up that denominator with different currencies, different methods. And then we started talking about what you were suggesting with your spread trading technique. And I was wondering, how do we really mix up that diversification in our portfolios to reduce our dependence on a particular currency to produce this diversification benefit through principles such as your spread trading that you're talking about? What's the mechanics and how do we do it?
Hey everyone, thanks for being there. And sorry, I'm not sure if I was a little late to the conversation. I thought it was 3 p.m. my time, but when I got on at 3, you were already chatting. So I'm not sure if I'm late or not. But anyway, good to be back on. You know what's interesting is, but essentially we're trading a spread with every market that we're trading. We're trading the euro in US dollars, and we're trading the Japanese yen in US dollars. You may decide to trade it against euro, or you may decide to trade it against British pounds, but every market has a denominator, and most markets are denominated in US dollars. I don't mind it that much. I don't mind it at all, I need to say, with some of the commodities, or all of the commodities, because they're global markets. They're really, traded all around the world. China buys corn from the US and soybeans from the US. They also buy corn from Europe. If it's the same type of corn, it will have roughly the same price in euro or dollar. If you multiply it by the FX rate. But where I see more of a cluster in terms of risk, that you can diversify away to an extent is in the currency sector. Most of the liquid futures contracts, they are dollar-based futures contracts, euro dollar, Canadian dollar against dollar, Mexican peso against dollar, Aussie dollar against dollar, is all against the dollar. And so sometimes you just have that, dollar strength. And the entire market is short dollar and wants dollar, especially in times of market stress. There's a flight to quality, there's a flight to dollar. And that makes the dollar very strong, and therefore all the other currencies weak. Now, you could say, okay, if that creates trends in all of these markets at the same time and I can participate in them, then that's great. My personal experience is that you can get a little bit more diversification in that currency sector if you are specifically trying to move away from having everything against the dollar. Have some British pounds against Japanese yen. Have some, Hungarian forint against South African rand. You see where I'm going. Other type of, like the miners, I'm not sure if people trade the exotics, like the really small currencies, but definitely I think there's a benefit of going into the miners and not only trading the majors, especially not only the US dollar currencies. But that is a different different thing than what I do with my spread trading. That is just market selection and being mindful about things being denominated in US dollar predominantly.
Gentlemen, I'd like to say something. I'm pretty new. I'm not sure if I click the right microphone. So I know we're talking about AI, machine learning, and I remember it reminds me a quote by Bill Dries, and he said, "Oh, if all it took to beat the markets was a PhD in mathematics, there will be a hell of a lot of rich mathematician out there." And interestingly, these days I'm studying at Sakota and about in regards to psychology sectors of trading and such as risk tolerance, emotional control, our fears, greed, hope, ignorance, and etc. So I would love to hear your take on that, especially Jerry. What's your take on this topic, Jerry?
Thanks, Lulu. Um,
Thank you.
I think there are a lot of mathematicians, and so the wealthiest traders ever probably are those guys at Renaissance, and so I think it's just difficult and hard, even if the mathematicians competed only against themselves. It's just so hard to be number one and so we can all, the normal people, guys like me, can step out of that and not fight that battle, but create a situation where we're mostly just fighting ourselves and our human instincts of wanting to not let profits run and not take small losses and not
Right.
wait for big trends. And so we're in the trend following strategy, i.e., hopefully the mathematician guys don't get in our way or don't minimize those outliers too much. I have a good life in the markets and trading. So I guess it's a lot of different ways to do it. I think the trend following way is open to more people than the high level math way.
Thank you.
But back to more, yes, sometimes, some of these podcasts or whatever, and I get started being asked this question about the dollar. And of course, I don't, look at the dollar. I look with ruble, long sum, short. And so I'll try to interject, hey, we have diversification here. We and the Israeli shekel are the strongest. But then they'll say, well, what about the dollar? What about the dollar? So I'm like, I think I'm right about this. I think if we're long the dollar, we got rid of our dollar position. So yeah, this confuses people. And I can get confused as well.
I want to say that the ruble is a very interesting currency. In 2015, it was a very big sell off of ruble, and in this currency, yes, maybe it looks different from other currencies in some case, and this currency have ability to lose its weight. I think so. So a big trend opportunity here.
Yep, I was really interested in what Moritz was saying because my concern is that when we deal with correlation within a portfolio, and for instance, when we examine the correlations of our portfolio over a very long time frame, we find that these correlations, there are periods of time where we become positively correlated. There are periods of time where we become uncorrelated, and there are periods of time where we have anti-correlated relationships. And I'm just wondering what sort of dominance is being exerted by this large component of US dollar denominated instruments in our portfolio, and whether that we can significantly reduce the building correlations that we've observed post 2010 up to say 2021. In March 2020 or February 2020, where everything started going south, and I was wondering whether that was more a case because our portfolios were loaded with US dollar denominated markets, as opposed to necessarily the correlations that existed in the markets we traded, if that made sense.
After last week's Clubhouse, I went to the charts and I looked back in February at all the markets that were selling off to see if I could denominate some of those markets, commodities. Yeah, I guess I was looking at the commodities in another currency and to see if there was any meaningful change. And there was not. There was no meaningful change in taking the weakest currency and converting all those commodity markets into that. Um, except, it's like Derek said, when you overlay your system on the markets, it does become this different synthetic market that, and so some of the exits were barely missed. So palladium was a good example, that it was a horrific sell-off, and my long-term, all my systems got exited out. But when I converted it into other currencies, it barely missed getting me exited out. So the correlations and the charts looked almost identical, but once again, adding into adjusting the data a bit did create different performance, and it was materially different. Can you imagine the difference between getting out of that platinum right at the low with this monster sell-off, only to see it rally back to new highs in a few weeks? Yeah, that would have made a big difference to your performance.
That's good to know, Jerry. Look, I don't want to fixate on this issue. I'm glad you had a look at it. I haven't done it. I do have to do it, but I suppose it might sort of assist correlation around the boundaries, but it might not be a major contributor. I just thought, maybe this is one of the issues why we did get this super correlated moves in that time, but it's good to know.
Yeah, and from a philosophical point of view, why stop at the currencies? Perhaps there are relations, and I think that's what Moritz tried to exploit on his spread systems. At least that's what I get from his from the talks in the podcast. There is a relationship between the metals and oil, because oil is such an important input. So why not look copper in terms of copper in terms of the WTI price? Perhaps that's a meaningful relationship. Why not look at the grains in terms of oil? Why not look at the grains in terms of themselves? There is a ratio of demand when you're producing ration for the animals, that's a fixed amount of soybeans and corn that you need to use. I mean, from a philosophical point of view, why stop at the currencies? If you want to evaluate these relationships and how they can trend themselves, look at the palladium in terms of oil. I don't know.
Yeah, it's Mertz here again. I think you could look at the DAX in terms of WTI, and you can look at the Aussie SPY and divide it by soybeans, and all of these will create a synthetic market, a new market that you can work with, a new spread market that you would trade. But it also creates a massive matrix, a massive list of markets, some of which will then again cancel out, I think. I'm not sure if, I'm not sure if, well, I'm sure that I don't want to add that type of complexity to my type of systems. It's probably a bigger research project one would need to have a look at, to kind of like denominate everything that we trade in something else, so you have this massive spread matrix. For my spread trading, that is actually not what I'm looking to exploit. I'm not thinking along the lines of, okay, it takes a lot of energy to produce aluminum, to refine aluminum, right? So you could say, okay, there must be a relationship, obviously, between the input cost, which is power, and the price of aluminum. And how do you generate power? Well, you generate power predominantly by burning gas or coal or uranium, and then putting that into a nuclear reactor. So all of that ties together, but these relationships are too complex for my system to pick up, and I'm not sure if I'd be very good at picking them up in the first place. I know they exist, but I don't trade it that way. I really look at these spreads from a trend following point of view. I look at a selection of markets, not all markets, so I don't have my complete portfolio available to spread trading. I don't go through all the markets that I trade and look at all the possible spread combinations that would exist, because it becomes, the permutations are just far too many already. So I don't do that. I have a selection of things where I think there's a reason for a spread market to be there. And by the way, there are spread markets on the exchanges, right? Especially in the commodities, but also in some of the other markets. And then I trade things against each other. I trade calendar spreads, long and short. So long means, you have a bull spread on, you're short the front month, you're long the front month, or you're long a near dated month and you're short something that is further down the curve. And a bear spread, where you short the spread, that means you're short something that is closer to today and you're long something that is further out. Most of my trades are actually in that category. Probably 50-50 in terms of bull spreads and bear spreads. I had a nice bull spread on in natural gas that got stopped out. I was able to close that with a small win, but natural gas is very volatile right now, especially here in Europe. It's more volatile in Europe than it is in the United States, but it also got pretty volatile in the United States, Henry Hub, in the past couple of months. So I do things like that. And when I do this, I'm very mindful of seasonalities. So I don't allow my system to trade winter into summer contracts. So natural gas, for instance, has summer contracts from April to October, and it has winter contracts from November till March. This is kind of like the definition. What I don't want to do is, I don't want to trade March, April, because that will be a winter-summer spread. And those things, they can be just massively volatile, right? If there's bad weather and natural gas, then these things can be really killer things. So I don't want that. So I trade winter against winter, I trade summer against summer, I trade new crop versus new crop in the grains, and old crop versus old crop in the grains, these type of things. But then I also trade cross-market spreads. And there my system is much more liberal in the way that I can pick these markets. And I let the system determine what the markets I trade shall be. So it can come up with things such as sugar versus, I don't know, soybeans. That has happened. there's no relationship really of sugar to soybeans that I know of. There's no substitution spread, there's no crush spread, there's no geographical arbitrage that you can do from sugar into soybeans, and I don't think that they're going to be feeding cows and pigs with sugar because they need soybeans for that. But I kind of like detect different trends, really pure trend following type of thinking here on the spread of sugar to soybeans. And then I want to belong the market that has the stronger trend to the upside, and I'm short of the other thing. And that has a nice effect on my portfolio because I think of it as a diversifying new market. That's one thing. And then what it also does, it sometimes then plays along very nicely with the position that I have the outright positions that I may have on, not necessarily do have on, which I may have on in these markets, so sugar and soybeans in my example. Maybe I'm out of these markets because my system didn't detect any trends, neither to the upside nor to the downside, but there's something going on in the spread market, so all of a sudden I have a sugar-soybean position that otherwise I wouldn't have. And sometimes I have positions in the outright markets and then I trade the spread. The spread may actually cancel those positions out or amplify them. It very rarely cancels them out or amplifies them too much because they tend to be at different points of the futures curve. Sometimes it does happen that I'm kind of like getting into the same expiration month, but really most of the time, if say I have a long position in sugar, I would probably have that at the relatively shorter end of the curve, right? In one of the near-term expirations in my outright trading. But yeah, I may have a sugar October 2022 contract on right now in my spread system, which is nowhere near where I am with my outright system. So I get diversification there, and that is really great. It has worked well for me so far, but I have, what is it, a year and a half, something like that, of a live track record with that system. But I don't regret having finally implemented it after many years of looking at it.
Moritz, I have a question about this, the cross-market spreads, because, like you said, there's not necessarily a substitution there, so it doesn't necessarily follow, like you said before, a substitution or like a crack spread. So, are you looking for any relationships between those things, or any kind of criteria that these things should be related, or just that there is some kind of trend following like move in those cross market spreads?
The latter. I'm using a co-integration technique there. You probably know what that is. I mean, it's measuring whether a spread between markets is stationary or not. It's something else than correlation, but so it's technically what I'm looking at is co-integration, and I look for co-integration to have a breakout or a failure, and then translate that into a position in these markets. But really, from a trend following perspective, I don't want it to mean revert and say, okay, it has been co-integrated in the past and now it's not co-integrated, so I kind of like do a mean reversion trade. That's not what I do. I really want to, follow the breakout, but it's a breakout of a different thing. It's not necessarily it's not a price breakout here at that point, but more a statistical breakout of a measure that I'm using that indicates to me that there's something now happening in the market that hasn't happened in the past, and it's kind of like that spread relationship is about to get moving, and then I get involved. That's what I do. And then I have the same thing with I have with my outright markets, which is I get in with a certain amount of risk, and I have a stop loss. That's very important. I don't want those spreads to. I don't want to handle them in any different way and give them more leeway or more space, more risk potential or loss potential than any of the other trades I do. I just handle them exactly the same. If they cost me a certain amount of basis points, then I'm out. Try again. Do the next trade. That's how I do it.
Thanks for that. That's actually really interesting. I like the concept of looking for the breakdown of a statistical relationship, because I mean I don't know if someone is looking at the sugar soybean spread in particular, but the idea that someone else might be looking at it, or something is triggering it to create a scenario whereby you could have this trend. And I mean, to me, it's kind of an intuition behind like a regime change, that there was a relationship, there isn't a relationship anymore, and that relationship was co-integration, so it was mean reverting. Potentially, it's not mean reverting anymore, and then that's a way to get active, and then using the like kind of golden rules of trend following. You know, we have our stop losses and trailing stops, and allow that thing to develop. I think is very innovative way to think about this kind of like infinite permutations of all of these types of spreads. Thank you for sharing.
Yeah, I'm actually trying to uh, simplify that spread model a bit more. I'll probably do it over the holiday period, which is usually when I have some time. But I always try to remove any unnecessary complexities, or where I think that there is a complexity then, and it's not really needed. If there's like something that I have on top that I could do away with, then I'm keen to do that. And so, for instance, one of the things where I'm probably too clever, or I'm trying to be too smart, is in the gas markets, where I allow for spreads being traded between Henry Hub and TTF. And then you go like, okay, so Henry Hub is quoted in MMBTUs, but TTF is quoted in megawatt hours, and there's a physics formula that you can use to translate one to the other, right? So you can translate the Henry Hub price into TTF price terms, and vice versa, obviously, as well. Multiply by the FX rate of your US dollar, and you get like a like-for-like comparison of TTF versus Henry Hub. So that's theoretically that is just possible. You can do that, right? And then some people, the physical gas traders, they do that, and they make a business out of arbitraging one against the other. But they are even like more into the details of knowing, okay, so there is a delivery hub and an LNG terminal in Louisiana, and this is where the Henry Hub stuff goes, and then you need to transport it over the Atlantic and have it liquefacted, I think is the term in Rotterdam, where there's a receiving terminal, and while the ship's in transit, you're losing 0.5% of the gas because it's under pressure. So they do all these calculations, right, and figure out to the basis points whether it's worthwhile hiring a ship, an LNG tanker, and moving the thing, have it fully insured, and move it across the Atlantic to just unload it in Rotterdam. I don't do that. That has no value to my system. But I do right now do this translation from MMBTUs into megawatt hours, in order to have a more of an apples to apples comparison of that spread, and then see if I want to take a position or not. But actually, I think it's not necessary to do that, because when I do whether I do that or not, whether I then run, at the end of the day, it runs through the co-integration type of thing. My system spots kind of like the same trades, or it will spot the same trades whether I do that conversion or not. So it's something where I probably, when I implemented it, felt like good about myself, that, oh yeah, there's something interesting that you can convert one from the other. And it's kind of like, you become intrigued about this because it is interesting, right? I like looking at these things. It's kind of like cool to figure that out, like how much does gas cost in the United States and how much does it cost here? And so, oh, well, right now it's 4 times more expensive here in Europe than it is in the United States. So I did the conversion. I don't think it's necessary for my system to work. It'll work in just the same way without the thing. So that will just, for a Christmas present, that will be dropped, and probably be no longer in existence 1st of January next year.
Maritz, can I ask you a question? When you see the characteristics of those spreads in terms of outliers, is it very different to the normal price trends or the price statistics? Because I remember that a couple of years ago, I remember seeing the spread of the oil against natural gas going like 20, 25, 30 standard deviations out of the norm. and I always thought that they were very different beasts. Do you think that's the same, or is it more common?
Yeah, actually, I'm just opening a spreadsheet here so I can give you some numbers and maybe go through a list with you. But I see the same picture that I see, well, not the same, similar, very similar picture that I see in my outright trading. Most of the spread trades that I put on become small losers or they scratch. They're a little better, I must say, than only just a little better than the outright trades in terms of winners to losers. So don't have as many losers, but really it's the same thing. Sometimes the spread gets going and then it becomes that outlier spread trade and I just follow that along and that pays for all the losing spreads. So when I go through my list here, just for you to get a feeling, so let me just read that out. It's about 20 or so markets. I can give you a feeling, you can understand where it is that I'm making money and how dispersed it is. So I'm up in feeder cattle, I made money in copper, I made money in crude spreads and natural gas. Massive loser in corn, massive loser in Kansas wheat, not massive loser in the sense that I had a massive loss, but the sum total of all the trades, I have most of the loss in corn. That's the worst market I trade against really anything. It just, as soon as there's corn involved, I can kind of like corn is the loser. So that's what I mean with massive loser. It is overall a losing spread market for me, as is Kansas wheat. RBOB gasoline is a losing market. BNOT is a losing market. Live cattle is one of the best. Really positive. Sugar, cocoa, soybean meal, and soybeans are really well. Interesting, right? So soybeans and soybean meal have traded really well over the entire backtest period. Always worked, but their big brother, which is one of the smaller brother, which is bean oil, that doesn't look very good. Coffee and heating oil, nothing. Scratch. Gas oil, scratch. Brent, scratch. Nickel, scratch. Cotton, loser. Lean hogs, of course, loser. Canola, loser. So there you go. It's about, what's that, 50-50? But some of the markets like live cattle and copper, natural gas, cocoa really strong, soybeans, those have had really good outlier trades, and then I just let them run. And they pay for all the other participants of my spread party.
And about the prices before you convert them to trades, do you see also the characteristic of the prices are the same as the outrights?
What do you mean by that?
I mean that the movement of the price of the spread, is it of those spreads overall before you trade them? Do you think that they are much like the same as the normal future prices, or they are more outlierish, so to speak, or they are more they are different? They have like small daily returns and then a huge difference in a couple of days.
Oh, that is
Or
very
do they
difficult for
behave
me.
the same as prices of the common futures?
Well, that's very difficult for me to answer. It really depends on the spread, I'd say. If I'm trading a calendar spread, a time spread of, say, soybeans November versus soybeans January, then that is a more behaved spread. It's a calendar spread of two maturities that are very close to one another, right? Something could happen there that just makes January move much more than November. But you expect that to be a more behaved spread in volatility terms than if I traded, say, soybeans versus cocoa, right? Because they're very unrelated markets. But I size them appropriately. I know about the average true range and the volatility of these spreads, at least the historical one, not the future one, of course. And I would therefore have more of a position in calendar spreads than in cross-market spreads, because the cross-market spreads can be more volatile. Can they break out? I mean, as I said, I don't take the spread because something has broken out in price terms, but I'm looking at a statistical measure to determine whether I want to go long or short, which is also nice because it gets me in and out at different points in time that don't perfectly correlate with my breakout trend system, where I make a new high or a market makes a new end day high, and then I would go long. That doesn't trigger the spread. Maybe it doesn't do anything on that day. It may trade, may not even trade at all. It may trade at a completely different point in time. Yeah, but then I sometimes see massive moves in the spreads. I mean, spreads can be very volatile, especially the cross market spreads, and sometimes the thing just gets going. Especially, I mean, this year has been great with all the big moves that we've seen in some of the commodities. I mean, gas, of course, but also the grains and some of the softs have had massive trends. And of course, that is something that I see in the spreads then as well. There's just, bean oil gets going and then boom. So I was on the wrong side of that thing, but anyway, it was quite a big move.
Yeah, I was thinking more in terms of the, as you said, the well-behaved spreads. Those ones that makes it, if I understand, make huge put up huge positions because of a small ATR. If those are, have any kind of different risk management for you.
No, they have no risk management. I wouldn't say that I've ever ended up with a huge position. I don't want anything in my portfolio to be huge, not even a spread. I treat them the same way. I mean, when you look at even look at the calendar spreads, right? Of course, like I said, the expectation of soybean November versus soybean February or January, the ATR contribution and volatility contribution of that spread is less than if you traded soybeans versus sugar. It's just one is the same market and the other one is two different markets. But when you look at especially some of the commodity spreads, the time spreads, historically through your data provider, you can do that on CSI. I mean, they're not exactly, they're not like Eurodollars where there's like nothing happening. I mean, they do have volatility in and by themselves. They're much more volatile. Calendar spread, regardless of how close you bring them together, really, I think, is always going to be many times more volatile than the bonds and the and the short-term interest rates. Maybe something like the Italian bonds, like the BTPs, that in that zip code.
Okay, thanks. I thought they were less volatile.
No,
Thank you.
they really have. I mean, you're lucky I'm in front of the computer, so just let me make that example here with the soybeans. Looking at soybeans November versus soybeans January, and doing a historical volatility graph. So boom, that thing has a volatility. So this is not an ATR. It's just a volatility of 15, 1.5, more than equities.
Yeah.
So this is saying I don't have huge sizes, huge position sizes in these spreads. I don't want them to be huge. There's spreads which are less volatile. Base metals, for instance, if you trade nickel versus nickel and these type of things, the forward curves of these base metals, they're much more behaved. I mean, I don't trade gold, for instance, because gold is essentially just almost priced like a currency with a stable forward curve. There's really no movement. Silver is a little different, but I also don't trade that. But some of the base metals have relatively behaved forward curves, and that means that any calendar spread that you're putting on is going to come with relatively little volatility. But if I trade aluminum versus sugar, then that is a volatile spread all of a sudden, and it would have a substantially different and therefore lower position size than if I did the calendar spread. But again, like look, soybeans, just 2 months apart, has 15% volatility. Now you can, I'm not only trading that spread. My system may tell me, you know what, you trade November 2021 versus say May 2022. now, because we're now talking about a 6-month difference, the realized historical volatility of that spread is no longer 15, it is now 60, 4 times as much.
Wow.
So that is a very volatile spread. It is more volatile than the equity markets. It's a more volatile. Sorry, I was looking at the wrong long-term chart here. Let me correct that. It is 40. Don't want to get you off there. It's not
Still a
60,
lot.
40. But still, quite some vol, right? And every year is different. I think, I know that this year, the past couple of months, those spreads have been substantially more volatile than they have been in recent years. It has been very good for me because I was making money from that volatility, but in years prior, some of the commodities weren't really doing very much, and also the spreads were more behaved in terms of their vol. So, yeah, no huge position sizes there.
Thanks very much, Maurice.
I'm going to ask Moritz a more meta question, because what he mentioned in his previous comment about I'm going to simplify over the holiday break reminded me of a comment that reminds me from the podcast where it's like Moritz reached maximum complexity. And I remember hearing that, I'm like, oh my gosh, I'm probably not yet at my maximum complexity, but it's something I'm really struggling with. How do you think about simplifying systems? What aspects of systems do you believe is to be like the fulcrum of the system? And then, what can be trimmed? And, what's kind of your process to do that? Maybe you can give me like a toy example.
If you have an entry and exit and a stop loss, then those are your guiding lights. That's all you need. You need markets and prices. I think you can build a very good system just with that. And then you can build an excellent system with just that, right? Reduce losses, let the winners run, and follow those rules. That's it. And all the other stuff that I used to put on, or where I think that I could add something, maybe an additional parameter or a slightly tweaked exit strategy that would look at something different. Yeah, I think I was kind of like almost in a way lying to myself that that really changed the bigger picture of the system. I don't think it does. I don't have any evidence that it does. So I do away with all these things. I don't have a cookbook where I can go through and say this is too complex and this needs to go and this needs to stay. It's more like me living with these systems, seeing them work, running them, trading them, and then over time figuring out that really, look, Moritz, there you've done something that doesn't do harm, but you probably don't need it, so it needs to go away. And that's what I do. Really, my systems today, I think, are very simple. At least for me. I mean, everybody has a different benchmark, but I think they're relative. They're very simple. Look, I spoke to a journalist yesterday about trend following trading. German journalist. Interview in German, so it's going to come out in Traders Magazine or something like that. And so we spoke for like 2 hours, and it was markets and trends and momentum and some really basic stuff. But then really, when I told him essentially all the things that you know from the podcast and this Clubhouse, so nothing of that is any news to you. But he was so surprised when so he was assuming in his head that, of course, I would need to trade different systems on different markets and different speeds on different markets because the DAX is so different to soybeans. And I told him that I don't do that. And then he looked at me and was like smirking and saying, well, you're obviously making fun of me because of course you do. You must do that. And then I asked him, well, why do you think should I do that? I said, well, because the DAX is different than soybeans. It's a different market. It has different market dynamics, and So you know where this discussion went, right? So yes, of course, the soybeans is something very different than an equity index. But does that really matter? I mean, what is different? And so we got into the entire thing that you know from our podcast discussions. And at the end of the day, I think I left him with a headache because he thought that he was going to get a cool interview and learn something that's complex, because we're treating these markets and we have these special recipes to trade bonds different than FX. And I think I was a little disappointed that I told him that it's just the same thing for everything. I'm not sure if he's going to put that in print. Maybe he doesn't believe me, but it's what I said. It's what I do.
By the way, it's a great part of our 24-hour philosophy to treat all the markets in the same way. It's very great to understand this, and it makes our trading universal. And as I said before many times, I think that Transform is based on general laws of the nature, and we can apply Transform to many fields of our life. And so I like this approach to treat all the same.
Well, look, we're coming up to 2 hours now. I've got to sort of turn off this recording now, as it's running out of disk space. But look, if you want to continue, please do. But thanks everyone for coming along, and it was great to see you, Moritz. Thanks for coming along. Hope you
Oh
come
yeah,
along
so
more.
now I realize that I was an hour late. I'm sorry. I thought it was 9. I thought it was 9 a.m. Eastern time, isn't
Yeah,
it?
it used to be. Jerry sort of put it
Okay.
an hour earlier. So
I didn't see that. Okay.
Well, Richard, thank you. I know you're burning the midnight oil quite literally here to
it
be
is
with us.
late
So
down
thank
here.
you.
All right. Thanks very much, guys. Bye.
Thank you.
Thank you, Moritz. Thank you, Richard.
Thank you.